Hello and welcome to this session in which we will discuss zero-based budgeting, continuous or rolling budgeting, project budgeting. We will also cover activity-based costing, but not in this session. I believe activity-based budgeting, it should have its own session, but in this session we'll focus on the first three: zero-based budgeting, continuous budgeting, and project budgeting. We will go ahead and start by looking at zero-based budgeting. If you know anything about Farhad, once I have a list, I'll go over each component separately. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello everyone. Are you struggling with your CMA exam preparation? Do you feel that your review course is moving too fast, too brief, or not covering topics in depth? Well, if that's the case, at Farhat Lectures, we can help you. We build your confidence through in-depth explanation, not memorization or reading the slides. What we will do is we provide baby steps approach to break down complex topic so you can truly learn, understand the material. How do we do so? We offer video lectures, we offer practice MCQs, we offer true-false questions, we offer exercises, we offer the notes. Understanding the material is the first step in passing the exam. Once you understand the material, you have gained the confidence to pass, and you can pass with Farhat Lectures. What can you do now? Start your free trial. You have a 2-day free trial. Take a look at it. Give us a chance. Your risk is zero. You like it, you keep it. You don't like, you cancel. Give us a chance. We can help you pass the CMA exam.
Zero-based budgeting, ZBB. What is the idea behind it? What's the assumption? Well, no assumptions for that matter are made from past year. So we start from zero. Each budget cycle begins with a zero base. We don't assume anything from past budget. Why? Because the traditional budgets, what they do is they look at the prior year budget and they make adjustment from there. Zero-based budget, on the other hand, require all expenditure to be justified regardless of past spending level. So what does that mean? It means the manager must justify every part of their department budget from zero, as if this is the first time they are creating the budget for that department. So at the end of each cycle, they will have to do that. Now, why? What's the benefit of this? The benefit of zero-based budgeting is what? It's going to encourage the managers, encourages the people that think about the budget to periodically review, which is on each budget cycle, review and identify potential savings, because now you are reviewing everything, ensuring that essential expenditure are approved. So you have to justify. If I'm going to assign any money to your budget, to your department and the budget, you must justify it, and you must do it on regular basis every time we create a budget. So management must assess each budget item from a cost-benefit perspective to make sure that each expense is contributing to the organization, and that's the benefit of it. Now obviously, just that there's a benefit, there's also a disadvantage, and I am assuming you are guessing what's the disadvantage. But let's look at the advantage one more time. It encourages more thorough evaluation of cost, potentially leading to cost reduction and elimination of unnecessary spending. So that's the benefit, is every year I'm going to question you about your budget. So justify it. If it's justifiable, that's fine. If not, and why would not be justifiable? Well, the environment could change, the product could change, the industry could change, many things could change. But if everything is the same from year to year, it's easy for the manager to justify. But if they have to do it every time, it's going to require time and effort. And what does that mean? It's consuming resources in contrast to traditional incremental budgeting. Why? Because you have to justify your budget every year annually. You have to rebuild it. It takes time to do that. But by requiring a fresh analysis of expenses, zero-based budgeting aims to keep budget lean and aligned with the current organization, although it can be resource intensive. So the benefit is you're looking at everything again. The disadvantage is it's time consuming, labor intensive, it's going to take resources. Let's take a look at the second type of budgeting methodology, and that's continuous or rolling budgeting. Just as the word continuous or rolling imply, it's a budgeting approach that's updated to reflect the latest available information. So what does that mean? It means as each month, let's assume we have a budget for quarterly budget, 1, 2, 3, and 4. So once the first quarter has ended, we go ahead and add another quarter. So now this one has ended, we still have a year, we are rolling the budget. So as each month, if we break it down by monthly or quarter concludes, elapsed, the budget is extended by another period, whether it's a month or a quarter, keeping the planning window consistently looking forward. But here what you need is regular updates. The budget is frequently revised and updated on regular basis. If it's monthly, it's going to be time consuming. For example, if the budget covers 1 year, at the end of each quarter, a new quarter is added, ensuring that the full year budget is always in place. And the benefit of this, it's forward looking. It helps the company looking forward, keep managers focused on future planning rather than on the current or past period. Again, the benefit is continuous budgeting keeps manager engaged in a proactive planning. It's going to foster a mindset of constant adaptation and long-term thinking, because now the organization have to stay agile. So I'm done with this quarter. I still have 3 quarters to go. Let me add the 4th one. So it's adjusting to market conditions and internal factor. The disadvantage is more time. It requires more time to budget preparation and adjustments, which also can be resource intensive, just like the zero-based budgeting. So it demands a greater commitment to ongoing budget management. So to physically look at one, let's assume we have this continuous budget for each product line, for each quarter 1, 2, 3, 4, and that's the total. For each department, what's going to happen is, as the first quarter has ended, so the first quarter is gone, what we do is we add, so we replace the first quarter of year 1 with the first quarter of year 2. So this is year 1. This is year 1. So what we do is we eliminated this one. Now we still have 1, 2, 3, 4 quarters. And as this quarter ends, we add a new one, the second quarter for year 2, so on and so forth. So we are rolling the budget. Project budget or project budgeting, as the name suggests, it focuses on the project cost. A project budget includes all expected expenses related to a specific project, such as designing a new airliner or building a ship. So we have a budget for a specific project. Now, although the project is a part of the company main business, its substantial cost and profit must be significant to keep track of it separately. So when do we use this budget? When we have a project that's significant. It's part of the company, but it's significant. And usually these projects draw resources from various departments within the organization: design, engineering, production, marketing, accounting, HR. But it's crucial that every aspect of this project must be aligned with the company master budget, which we'll talk about the master budget later. This type of budget ensures consistent resources allocation, accurate financial projection, and that the project's activities and objectives support the overall goal of the organization. So what we're doing is we're looking at a particular project that's so important, and we are creating a budget for that project specifically. It would look something like this. So we could have a project budget where we have many different function within that project budget. So it's per function. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following best describe the primary disadvantage of zero-based budgeting? It's a disadvantage. Well, zero-based budgeting, it often leads to unnecessary cost-cutting measures. Well, is that a disadvantage? Well, it leads to unnecessary cost-cutting measures. That's fine. That's great. That's actually an advantage because it leads to those unnecessary Let's take a look at this multiple choice question from farhatlectures.com. Which of the following best describe a primary disadvantage of zero-based budgeting? It often leads to unnecessary cost-cutting measures. Yes, it does lead to cost-cutting measures, but is it unnecessary? No. And is this a primary disadvantage? Also no, because the question is asking about primary disadvantage. It often leads to cost-cutting measures. True. To cost-cutting measure. It doesn't have to be unnecessary. It might lead to necessary, and that's one of its primary advantages. So it's not a disadvantage because there's nothing about unnecessary cost-cutting measures. It discourages managers from revisiting previous expenditure. On the contrary, it encourages managers from revisiting previous expenditure. So that's not a disadvantage. It requires significant time and effort to justify every cost annually. That could be a disadvantage. That could be a disadvantage because one of the disadvantages of ZBB is it's time consuming. It requires effort and resources on behalf of the manager because they have to justify the cost annually. It's only applicable for capital intensive industries. No, it could be applicable to anything. It doesn't fit there. So I would say the best answer is C as in Charlie. It requires each expenditure to be justified from scratch each year, which is time consuming and labor intensive. What should you do now? You want to go to Farhat Lectures, look at additional multiple choice, whether you are studying for your CMA, CPA, accounting courses, finance courses, professional certification. Invest in yourself. Farhat is always here to help.